Good evening and welcome to another edition of Capital Market Live on Channels Television. I am Will Ibong. As always, we take a look at how your investments have performed this week. But first, let's take a sneak peek on other global markets. We begin with Europe stocks, where markets closed higher on Friday as investors continue to assess the full scope of the European Union's trade deal with America, and hopes rose for a U.S. interest rate cut in September. Now, London's FTSE 100 closed at a record high for the fourth session in a row, adding another 0.13% on Friday to clinch its best weekly performance since May, driven by gains in mining, retail, and defensive stocks, along with purchasing managers' index data on Thursday showing the strongest business activity for a year. Now, the German DAX and France CAC 40 also closed in positive territory. Let's move to Asia now and see how markets performed. It closed mostly higher on Friday as investors await the U.S. Fed Powell's speech, which could offer clues to the path of interest rates. We see Japan's benchmark Nikkei closing up 0.05% at 42,633 points. We also see mainland China's Shanghai index jumping over 1% to close at 3,825 points, while the Hong Kong Hang Seng index added nearly 1%. Let's move to the U.S. now and see how they reacted to the hope of a Federal Reserve interest rate cut. We see the Dow Jones Industrial Average rallied to an all-time high on Friday after Fed Chair Jerome Powell signaled the central bank could begin easing monetary policy next month. The Dow climbed 1.89%, reaching a fresh high and closing at a record level of 45,631 points, and the S&P 500 rose 1.52% to end at 6,466 points, coming within 3 points of its record. And the NASDAQ Composite gained 1.88% and settled at 21,496 points, and that's a winner there. We see that for the week, we saw the Dow and S&P 500 advancing, but the NASDAQ slipped for the week. Now let's move back to Nigeria, the domestic equities market. We begin with the unlisted equities market, where the NASD Securities Exchange closed the week positive as the NSI climbed 1.45% to 3,639 points, and the market cap at 2.18 trillion. Activity was mixed. Volume surged by over 51% to 107.43 billion units, but value dropped by 65% to 384.11 million naira, while deals fell 31% to 122 transactions. Now, top gainers were Central Securities Clearing System up 10%, Mixed Real Estate up nearly 10%, and Food Concept also up 3.5%. But on the flip side, UBN Property dropped 9.5%, Air Liquide fell 9%, and Friesland Campina Wamco lost less than 1%. And the most traded securities were Purple, Real Estate Income, Industrial and General Insurance, and IPWA. Now let's see how the NGX fared at the end of the week. It was a bearish week on the exchange, I must say, as the all-share index dropped for the second straight week by 2.51% to close at 141,000 points, while market cap settled at 89.2. We've lost that 90 trillion naira mark there, but trading activity was mixed. Volume traded stood at 4.77 billion shares, down from the previous week, but value, we see it increasing to 107.4 billion naira, even as the total number of deals fell to about 152,965. But across the sectors, performance was mostly negative. Industrial goods led the losers with a steep 8.42% decline, followed by insurance, which dropped 4.17%, and banking down by 3.48%, and oil and gas by 0.84%. But on the positive side, we see consumer goods gained 0.83%. Now to the top movers. On the gainers chart, Austin Lars and Company led with a 20.83% jump to 2.9 per share, 2.2 naira 90 kobo per share, I must say, closely followed by NCL Nigeria up 20.69%, and Nigerian NML, which advanced by almost 19.5%. On the flip side, Thomas Wyatt Nigeria was the biggest loser, shedding nearly 19% to close at 3 naira NEM Insurance dropped by 18.15%, while Stanbic IBTC Holdings fell by over 15%. Now, for traded stocks, Universal Insurance, Zenith Bank, and FCMB were the most traded stocks by volume. It's stated now, the NGX has posted 2 consecutive weeks of decline, raising concerns among investors about the sustainability of the market's bullish run, with the all-share index still hovering above 141,000 points, and many are asking if this is just a healthy pullback or a signal of deeper risk ahead. For context, Nigeria's capital market faced a devastating crash in 2008 when the ASI plunged by almost 70% after a historic peak. Could the current rally share any warning signs with the era, or are we in a fundamentally different market? To help us make sense of this and what it means for investors, we have with us Mr. Kofi Garba, Managing Director and CEO of APT Securities Limited. Good to have you join us this evening, Mr. Garba.
I'm happy to be with you.
I just want to ask a very quick question here.
Yes.
What's different? Looking at the ASI dynamics here now, what's different from the nearly 70% drop we saw in 2008 from the sustained rise, in the all-share index that we've seen now to up to 141,000 points?
Well, there is so many differences. The first is the market itself. If you remember, by 2008, the dominant players in the market is the banking and the insurance. They almost constitute 50% of the market capitalization. Today, the entire financial sector, both banking and insurance, did not constitute more than 20%. And we have new players like telecom. The telecom constitute about 20% of the market. Cement industry constitute about 20%. And we have food and beverages. So the market is more diversified, and it's not like in the past. Not only that one, today the market is played by the domestic investors. The domestic investors control more than 70% of the activities in the market, unlike in the past, where the foreign investors were part of the, even about 50% of the player. Not only that one, there is the issue of margin account. In the past, most of the people, those who understand the market and those who do not, borrow money and play the market. Today, I can tell you that the margin trading did not constitute up to 5% of our activities. So most of the investors are using their own money, and that gives them the leverage to hold into it. And that is why you see from 2020 to date, all share index keep on gaining, because those are the major players, are the domestic investors, the Nigerian investors who understand the market and who are not panicked for one reason or the other.
Okay, so we're looking at the market cap as well. It's not just the all-share index that has risen here. We've seen that phenomenal, astronomical jump in the market capitalization. Does this larger, more diversified base reduce the vulnerability we see in the market, or does it present another systemic risk that we have not probably seen yet?
Well, it doesn't, because when you have a diversified market, it gives you the opportunity to play. Before, go and ask most of those who lost their money in 2008. They will tell you they lost their money in the banking shares or insurance shares. Today, if you choose to play banking and the insurance, you are just playing 20% of the market. So the remaining 80% can be without you. Today, cement industry is doing very well, and they have very good fundamental. Telecoms are doing very well, and they have good fundamental, and we have food and beverages. So this diversification gives the investors opportunity to look elsewhere. Not only that one, we have mutual fund, which before it doesn't exist. Today, as I'm talking to you, mutual fund control between 6 to 9 trillion, and that is about 10% of the market. Not only even the mutual fund, we have the bonds. We have federal government saving bond that issue on monthly basis, and you can collect your money on quarterly basis. We have Sukuk, that the last Sukuk 7 comes with 19.75%, almost about 20%. And therefore, the investors now have the leverages to diversify, not rely on equity. In 2008, almost 95% of our market is equity. Today, we have other alternatives that you can stand on, and they are not only reliable, and they are stable.
We're talking about other asset classes that have come into the NGX that maybe diversified the portfolio of investors and not just solely on stocks alone. What of ETFs? How have that performed from 2008? Like, has there been
They
any?
don't exist in that time. They don't exist. The exchange trade fund and the mutual fund, I can tell you that is almost close to zero in 2008. But now they are there. Not only that, we have gold, new gold. You can even buy gold. So we have more diversification in the market, and we have more other market to play. You can go to NASD, you can go to FX market, and all these constitute to the market. So it gives the investors opportunity to diversify, and that shedding the risk. Therefore, the likely crash we experienced in 2008 is not likely going to happen. And most of our stocks are trading within the fair value. For a market to crash, the PE ratio should be 20 and above. I'm telling you today, most of the stocks are trading in less than 10 PE ratio, so they are grossly undervalued. The very few ones that have a PE ratio of 20 and above, they are taking their correction, and within no time, they will get correction without people feeling, because most of the investors play the penny stock. If you look at the big stock, the telecom, the cement, they are all reading above 100 naira. And these, for you to even change the price, you need to trade 100,000 units. So in most cases, you need institutional investors to play that market, not retail investors. So the retail investors are playing less in the highly capitalized stock, and that will make less for bringing the market down.
Okay, so talking about the cautious investors now, because everybody definitely is cautious. People got their fingers burnt in 2008. Nobody just wants it to happen again or repeat of, what happened in 2008. So for cautious investors now, based on lessons from both eras, now we've seen the 2008, we've seen the 2024 to 2025. How should one calibrate one's exposure to the stocks right now or to equities versus what we saw in 2008?
Well, for the cautious investors, I advise them, don't put all your egg in one basket. Equity is one sector. You can put some of your money in the mutual fund. You can invest in the bonds, because we have bonds which are very reliable and very stable. At the same time, even in the equity, don't go into the financial sector alone. Move into other sectors. We have oil and gas. We have food and beverages. We have telecom. And all these play a greater role, and either of this market, you can make your money.
So is there any particular sector that investors should be looking at right now?
Well, for now, I will say agriculture, which fall under food and beverages. They should go into agriculture, because the agriculture have rewarded very well and are likely going to continue. Telecom, they are not left behind because of their review of the tariff. We also advise them to go into Spain, because we are a developing economy. We need more infrastructures. And as the election is likely coming, more politicians will go into construction, road, and what have you. And therefore, there is likely to see upsurge demand of cement. So cement are the stock also to look into.
Definitely, because real estate is now a big part of the GDP, and we see that growth. And investors, I know some investors or equity traders are moving to real estate to trade it as equity in terms of, bringing it on board on the NGX. Why are we not seeing more of that on the NGX, real estate, for example?
Well, you see, most of those who are into the real estate are individual. We need to educate them. If you go to Abuja, you see how the real estates are moving. But most of them, they are not into the capital market. Probably they lack understanding of the capital market. But if they come to the capital market, they will do better. We see what UPDC is doing now. And I believe that we, the players, the operators, need to reach out to these people, bring them to the market. There is no need to have a one-man business. Get it quoted, it will survive beyond you.
Okay, are there policies that is inhibiting, restricting them from coming on board, that maybe you feel that the SEC, regulators, and possibly the NGX should put in place to ease their entry and their listing on the NGX? Probably
yes. If you look at the rules of our listing, this is a rule that is cake. But I have seen the revised one, and very soon we'll expect it, which is expecting just a minimum of 50% share, 50 share capital is allowed you to list it. If you are talking of 300, it is a big number. But 50, I think, is something that even with the broker, we can do it in a day. And that rule, once it's approved and allowed, more companies are expected to come into the market.
Definitely something to look forward to, but we'll take a quick moment now, we'll take a quick break. Capital Market continues. Don't go away. Welcome back. If you're just joining us, we are watching Capital Market live on Channels Television, and we've been discussing the performance of stocks and especially the trajectory of the all-share index from 2008 up to 2025, how it has fared and what next for investors. But we're just looking at what's half-year performance here in the first half of 2025. The NGX oil and gas index declined by 12.03% year to date, making it the worst performing sector, while other indices like the all share index surged. Now, contrast that with 2024, where we saw oil and gas sector was the best performer, delivering roughly 170% gains, outperforming banking, consumer goods, and others. Now, this stark divergence from top performer in 2024 to laggard in early 2025 sets a compelling stage for examining individual sector players. Mr. Kofi Garba, Managing Director and Chief Executive Officer, APT Securities Limited, is still with us in the studio. Sir, just walk us through this year. Oil and gas sector, 2024, best performing stock, outperforming and best performing index, outperforming others. We saw investors smiling at the end of 2024, but now we're seeing it down 12 points year to date, down 12%. What happened here? Can you just tell us the names that are responsible for this, or what is happening to that?
Really, the major player that give the high return in 2024 do the otherwise in 2025, particularly Ondo. Ondo moved from 7 naira to as high as 98 naira in 2024. Ondo often was around 70 naira. January. Today, as I'm talking to you, is traded less than 50 naira. So it lost heavily, and that affects the oil index. The other one is Aradel. Aradel, they have done very well. When you look at their Habia and their first quarter, their dividend, they did beyond the expectation. But the major problem of Aradel, there is a private equity investor who has about 17% and want to get out of the market. So he keep on supplying to the market, and that's what retard. I think by the time that issue is completely taken from the market, I see Aradel doubling the price because they have all what it takes to go there. Even for the Ondo, is a bit, when you look at the Q1, it rise. Is by the time they release the Q2, the other issue come down. And this is generally because Ondo, they are highly geared. And because they are highly geared, they have no choice than to pay the interest of the fund. And this is really affecting the company because I look at their Havia, they pay almost about 200 billion. So you can imagine if a company pay 200 billion as cost of the fund, what is left for the shareholder? Almost nothing. And this is what is affecting Ondo.
Okay, just look very quickly. Let's just do that comparison, get that table. We can have that on the screen there. We see Oando, Aradel, and Seplat, one of 3 giants in that oil and gas index there. Looking at the FY, that's the full year 2024, in terms of revenue, Oando outperformed. Shown, it was the shining star there. It's 4.09 trillion naira for revenue. But when we come to the profit after tax there, we see it at 220. That's on the screen, 220 billion. If you look at Aradel, they had less, 581.212 billion. 2 billion. And in terms of profit after tax, it was higher than what we saw for O&O. But we see Seplat had 1.65 trillion as revenue. We came to the full year profit after tax. It's surged higher than the rest. So, talk to us now. We see O&O distributing shares, units of shares, instead of paying actual cash dividend to investors compared to its counterpart in that sector. We see Aradel pay 22 naira per share. We see Seplat paying 0.16 cents to shareholders there. What is the difference here? What makes Aradel and Seplat perform better than O&O when they're all in the same sector?
Well, Ondo is different in the sense that they keep on acquiring. They acquire Egypt oil and they have to borrow to acquire it. And don't forget, they borrow in foreign currency and there is devaluation of Naira. And therefore, that affects their performance. And because they are highly geared, today, as I'm talking to you, on the heavy cost of fund. In 2024, they pay over 224 billion. Assuming they are not geared, their profitability will be over 400 billion. But if you look at Aradel and Seblat, their gearing is minimum and their wash is cash. That is why they are able to pay dividend. Ondo cannot do that for two reasons. One, already they use their available cash to acquire about 4.2 billion to let the other person out of their shareholders. So technically, Ondo, they have used their available cash to settle the dispute that what put them for long. Now to get out of it, they have to settle that owner of the share by acquiring it. So acquiring 4.2 billion eroded their available cash. So the only option they available for them is to give the investors share because there is no cash. Secondly, their shareholders is negative. When you are in negative, they are lucky that they are in the oil industry. Assuming Ondo is a bank, CBN will take it over and the shareholder will have lost their investment. But because this is not a regulated institution, so they can manage it, and with now the coming of the policy of debt to equity, you know, they come with the offer that the shareholder approve them that they can convert some of their debt into equity. And that will be the saving ground for them. Because I have seen that they almost pay about 200 billion as cost of fund for the Havia. What it means that by the end of the year, they will pay about 400 billion. So if they can convert some of their debt into equity, that can save them, let's say 50%. That will save them 220 billion. And when they add it to the profit, the shareholder will have something. The MD have already come and said that by 2025, they will pay dividend. So we hope to do so. But my question is the timing. Because the audited account has a lifespan of 9 months. We are in August. So remain less than 5 weeks for the audited account 2025 to expire. And we have not seen audited account of half a year. So if they are coming to the market, they either come on or before September, or else they have to go back and get audited account of their half year or 3/4 account before coming to the market. In any way, for Ondo coming to the market is a welcome diploma. For Aradel, they are okay. We have seen what they are doing. We have seen growth in their turnover by 44%, and we have seen even by their half year, there is growth. And one thing was Aradel, that no any other company does it. In their last quarter performance will outperform the Q1 to 3. We have seen it in 2023, we have seen it in 2024. By the time they release their Q4 result, outperform the entire cumulative performance of Q1, 2 to 3. So whatever you are saying Aradel, you will not know Aradel until by their end. And therefore, if they continue with this, so whatever they declare now, they can do more than that by the time they finally this. And it's a stock for the future. For the sublat, I believe that what retarded the sublat is their pricing. They have less than 1 billion shares, and their price is over 5,000. So to buy just 1,000 units, you need 5 million. How many of our retail investors can afford to that? So they either split their shares as Aradel did, because Aradel split their share by 20. Every 1 unit split it into 20, and today you can see, despite that, if you look at their valuation, you are talking about 2.3 billion, trillion, compared to Ondo that has less than 600 billion. So, but in terms of asset-wise, Ondo outweighed the assets of Aradel and Seblat.
Okay.
But I believe that with this restructuring they are coming with, that will bring hope. And I can see that is a stock for the future.
Okay, so with these ups and downs that we're experiencing in the oil and gas sector right now, is it a good time to get into the oil and gas sector, to buy oil and gas stocks?
Look, let me tell you, recently Shell decided to invest more in the Nigerian oil. And globally, they have done their statistics. They say in the next 20 years, oil will remain the stakeholder energy. So therefore, I have no doubt over the oil companies. We have confidence in them, and they are not doing bad, and therefore you can invest even now. On is trading less than 50. If you did not take on that 50, come by next year, you may have to double to get what you want to buy today. So if you are investor for the long term, I can say it's a stock for the future, both Ondo, Aradel, and Seblat. They have nothing wrong, and I can assure you, since Ondo promised to pay cash dividend next year, they will do it. And already Aradel and Seblat, they are one of the major paying out dividend. And this is the welcome development for especially the retail investors.
Thank you so much, Mr. Kofi Garba, Managing Director and Chief Executive Officer, APT Securities Limited, for your perspective. We look forward to great things from the oil and gas sectors. Yes. And it's good to have you. We'll see you next time.
Thank you for having me.
And that's it on Capital Markets. Another edition. We'll be seeing you next week. Remember, always trade your plan, have a plan for the market, and keep watching. Get information, because that's what you need in the market to thrive in this market. Remember, I'm always Will Ebong, and I'll see you next week. Stay fine.